Hi everyone, good evening. Do you hear my voice? Do you hear me clearly? Okay, I'd like to welcome all of you. Thank you for joining us. I'll be with you today to introduce a new webinar where we will be speaking about how to anticipate the future movement of the market. The previous webinar was about the FX market. It was like an introduction to the market. But this one I'll be I'll proceed further, and I will be like talking about some technical factors or methods that you can use in trading so that you are able to make money. So this is the idea. It's all about making money. Now, guys, it's all about understanding the chart itself. Now, think of the market as if it is a language, and you have no idea about this language. So you have two ways so that you are able to understand it. The first one is to send your translation or whatever that you want to translate to someone who's able to do so, or maybe you can learn the language yourself, and in the future you can simply understand everything very easily. Now we're going to take the second way, that we want to be able to read what's on the chart ourselves. It's not about sending our charts to someone who has the ability to read what's on the chart. It's all about the fact that we want to do this ourselves. So first of all, the chart is everything. The chart is everything that you really need so that you are able to read the market, to expect the future movement of the market so that you are able to make money. The chart consists of many things. To the right, you're going to find here a vertical line that has prices. To the downside, you're going to find another one, a horizontal line that shows time and dates. To the upside, to the left, you're going to find here the name of the currency pair that you want to trade. And within the chart itself, you're going to find some bars that would reflect what's happening between two currencies. Because we know that a currency pair, the components of any currency pair are two things: base currency and counter currency or code currency. So in this very case, what's happening right now reflects the fight or the war between two countries, I would say. So maybe we need to discuss some definitions here. First of all, the tool that we're gonna use called technical analysis, and this is, I believe, the main tool that anyone must use so that they are able to understand what's happening in the market very effortlessly. In this very case, I would say that technical analysis is simply a way to read what's on the chart so that they are able to expect the future movement of the market. And technical analysis is simply based on three concepts. History repeats itself, price moves in directions or in trends, and market action discounts everything. So these the three ones. I'm gonna focus on the two first ones. History repeats itself and price moves in trends. History repeats itself simply means that I would say it is the assumption that is history repeats itself, where price movement and concern. This reputation of price movement, according to technical analysts, is due to market psychology. This assumption simply depends on the fact that the market will always have a consistent reaction to similar situations because of the behavior of investors repeats itself. Price movement patterns can be charted out, allowing technicians like us to recognize patterns and select pairs that will have a, let me say, a probability of succeeding better. So what happened before might happen again in the future if the same factors that caused it in the past happen again in the future. Now, I'm going to go to the chart, show you some cases. Okay, there you go. Here, for instance, I think I need a naked chart. Gold, okay. There you go. For instance, in this very case, I'm going to show you something that is really important. If I highlighted this area, I would find that when the market reaches this area of resistance, okay, forget the first time. This was the first reason why the market went downwards very sharply from this point. I don't care. I just care about one thing. When the market reaches this area for the second time or the third time or the fourth time, here comes my mission. So from this very point, I'm going to enter the market. And then I would go short. Again, I would go out. The market goes up, then I go short, and so forth and so on. So this is simply the assumption that history repeats itself. This happens all the time. Why? Because the market will always have a consistent reaction to similar situations. Now we never know. We don't know really what happened here. So I don't care. And here as well, and here as well. But when the market, I mean, look at the chart. This is what you just need. When you look at the chart, when the market reaches this area of resistance, then you're going to find that the market is pushed downwards. All of a sudden, the market goes downwards. You don't know the real reason behind this movement, and we don't care. We just care about one thing, that when the market reaches this area of resistance or this area of support, I'm gonna take an action. This action could result in making money or losing money. You know what I'm saying? If the market goes against you, then you have anticipated the market the wrong way. And this happens, nothing wrong with this. But out of 10 trades, at least you must have like 7 to 8 trades, winning trades. This is how it works. Other than this, you'll need to reconsider your trading method. So yes, this is how it works. Now, the chart, as I told you, that history repeats itself, and we have another assumption that price moves in trends. You either find the market goes upwards or downwards, or maybe the market goes sideways. Sideways like this. Look at this chart. It goes up and then goes down. It goes up and then it goes down. It goes up, then it goes down at the same range of prices. So the same range of prices would simply be your zone where you can trade. To the upside, you can sell. To the downside, you can buy, and that's it. This is how it works. So you either find the market goes upwards, or you would find the market go downwards, or maybe the market would go sideways. So if we zoom in a little bit here, like this, we're gonna find these bars, and these bars are simply what we want to be focusing on. Okay, now the market consists of peaks and troughs, highs and lows, highs and lows. This is how it works. This is simply how it works. Okay. Guys, do you hear my voice clearly? Okay. So these peaks and troughs would simply make trends. So what is a peak and what is a trough? A peak is simply something that looks like an inverted V shape. The highest part here is peak, and trough is the opposite. The V shape, and the lowest part is simply the trough, which is this point. Okay. So this is simply how it works. You have peaks and troughs all the way that would make trends. Okay, guys. So as I told you before, that this is going to be like an introduction to how to anticipate the future movement of the market. So if you have a series of peaks and troughs that are going upwards, you have an uptrend. If you have a series of peaks and troughs that are going downwards, you have a downtrend. That's it. Okay. Now, based on this, we have what we call support and resistance levels. A support is something that could be found below the price of the market, and you can draw support and resistance levels on peaks or on troughs. Okay, and resistance is a level where we could be found, where it could be found above the price of the market, and could also be drawn on peaks and troughs. One peak is enough, one trough is enough, nothing wrong with this. So I can go long if the price reaches a support level. I can go short if the price reaches a resistance level. Okay. Now, this is simply support and resistance levels. We have also trend lines. Trend lines are lines that would give us like stations where we can enter the market. Okay. Just like this. Maybe this is a downtrend line, a line that connects at least two peaks. Then from the third, you can go short. This is called a downtrend line. An uptrend line, on the other hand, is the opposite. That is when you have okay, just like this. This is an uptrend line. So if the market reaches this line for the third time, you can go long, okay? It's a line that connects at least two lows, two troughs. And there is something that's called the rollover, which means that if the price must be found above the uptrend line or must be found below the downtrend line. If the opposite happens, then here comes the rollover, which means that instead of going long, in this case of the uptrend, you can go short. And if you have a downtrend, the market goes above it, then you can go long. This is how it works. Okay. So do you have any questions before I carry on? Okay. Okay. There are two things that I must refer to, we have two definitions: breakouts and bounces. A breakout is simply when the price goes beyond a specific level. A bounce when the price rebounds around a specific level. Okay, this is a very important thing, guys, to keep in mind. Okay, guys, so I'm done with these basics. If you have any questions on this, feel free to ask your questions. Okay, guys, so I hope that you have enjoyed this webinar and enjoy the rest of your day. Okay, stay tuned for our upcoming webinar and bye for now.